The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi folks, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday, 11 o'clock till noon, right at this time, at 877-927-6648. Thank you, Larry, for a great couple hours there. Whoa, this is very interesting. We were supposed to get some kind of a pullback based on the Chapman wave methodology, where the Chapman wave trend gauge flashed a signal. It flashed a signal Friday to say that there should be, there's a good chance that within 2 days there's going to be a very sharp move overnight in the E-mini futures, and that should translate to the cash indices rallying sharply. We got that yesterday. There was also a signal yesterday, intraday, to say the Dow, one goes to the S&P, the other implies that the Dow would have some kind of a rug pull. I thought the rug pull would be fairly shallow with a rally. We actually got that. And then suddenly, and I believe it must be the oil price, because oil suddenly slumped. So we're going to go through a lot of things here, and I want to try to answer a couple of really good questions. Actually, let me do this right now. I'm almost sure that I'll forget about it. So I'm going to type in FDGFX. FDGFX. That's the Fidelity. Got to type in the right place. God, I wonder why they changed that. FDGFX. GFX. Here we go. And the question was, actually, it was more a statement, and I agree with the statement. When you're looking at mutual funds, at the end of the day, you get one little line, one little dot, because it gives you the closing price only. It doesn't give you 100, at least I never get 120-minute charts. But then the weekly gives you highs and lows and closes, full candles, and the monthly. And the question was, so the statement was that there's just a dot. Yes, there's a closing price. The question to go with that was, is it possible to do Chapman wave notation? Well, it was funny that I got that question, because years ago, I used to hand chart. I used to take a piece of it was engineering paper with tiny little squares, and I made each square a point. I think it was a point, and I went all the way back to the 1920s and charted the Dow. There's a great book, I don't know if I've still got it, with the closing price of the Dow going back to I think it was before the 20s even. Yeah, of course, the closing price would go back to certainly when the book started in 1890. So when the prices started in the stock exchange. So here we go. The answer is yes. I used to do this by hand, and I used to do it on the Dow, the FTSE 30, that's the London market, and the Nikkei, or Nikkei, the Nikkei. And I did that hand-charted. And I used to have to extend the pages. Obviously, as you got into 1987, the page that was for 1932, when the Dow was at 44, was a lot different in that tiny little span within one page to when I was gluing on the crash of October the 19th, 1987. I had to get out the glue and glue another page and get my 2 pages, I think. I get my 15-inch ruler to draw a 500-point down move. So I used to chart, and it's real simple. If you're looking at this chart on the left, as I say, this is a Fidelity, what is it called? Fidelity Dividend Growth Fund. It doesn't matter what it is. I just grabbed any old fund because I wanted to get the price. So that's the most obvious lowest low. So where would A be? A is right here. This is the chart on the left. And B is where we are today. Today meaning yesterday, because that is the price of the 22nd. We won't know until the end of the day. So yes, I did that. And it gives you a more complex waveform. In other words, there's a greater chance of going to E's and F's. But yes, it works perfectly. It's the way I used to do it. I still do it in some situations. I often do it now in the options market when I'm charting an options price, because sometimes they have this tiny little, not even a candle, just a line. Okay, so I answered that. The next question was, we wanted to talk about, is this a time to be investing when in fact the monthly charts are still quite negative, even though the daily has really improved a lot in almost all the indices, and the weeklies have been improving. So let me get to that. I want clear thinking. I want to do it maybe in my third time slot. So let's just get this out the way here. We're going to talk about the Dow. I'll do the charts at the same time. The Dow is down. Now, this is way more than I expected. It's still just an inside day. Yesterday, we were up 225, up even more intraday. And I'm still remaining long. We haven't been stopped out of our positions. That is the positions on the Dow. One of the positions, I believe, I'm not sure. Let me just double check here. Yeah, I think we took a profit in one of them, an ETF based on a particular sector. All right, so here we go. So there's obviously now a really good chance that by the end of the day, we won't get to 16,665 in the Dow, which was yesterday's high. We're trading 200 points lower, just over 200. We've just given back 220 points. So this is going to be very interesting. Why? Because it's still way above the 9-period moving average. The MACD is still very strong. I have one indication, and that's the reason why I say that I don't want to add any new positions today, even though they're actually doing really, really well, because I wanted to see how this pans out. And one of the reasons is, I suppose technically I should still say this is a leg E/B to the upside. There's a lot of evidence to suggest that it's probably B. I don't know. The day is young. I don't know how much we're relying on oil, but you've already got a larger arch formation rather than the usual H that goes to an M pattern. Let me just show you what I'm talking about right there. That's on the left. Maybe I'll make that a bigger chart so that you can see there. So the Dow was 16,510 for that peak that went into an arch formation, successfully retested by not breaking the January 20th low. It went to 15,503, higher by 50 points. And then it ran very sharply to 16,664 yesterday. So far, this is against a very, very negative backdrop. And I have to say that if the Dow closes under 16,300, I'm going to have to suggest that the arch formation is just making a larger arch formation. If by the end of the day there's some kind of a turnaround to go from Dow minus 172 to say Dow minus 85, I'd much prefer minus 65, but anywhere around under less than minus 100, that'll say, okay, nothing wrong here. You've got 3 great green candles. You've got one tiny red candle yesterday with a closed tiny little wick. I mean, compared to the other intraday moves, tiny move, closing at the high, very strong move yesterday, right to the resistance line that I drew in. And now we've got a consolidation session. But look, the MACD is still good. Whoa, that was a quick break. So let me just run these numbers now as the break's coming up. The Dow's down 22 at 1922. The comp index is down 61 at 4506. The VIX is now at 2103. It's well over the 20 level. Got to watch that. And the GLD's up $1.65. Gold's up 15. Silver's up 42 cents. High-grade copper's up 42 cents. I'll be right back.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. So we're back. So let's just go on here because the QQQ series is down at 101.85, down $1.43. I've got this as a peak C. In the daily chart, the MACD is good. So the stochastic is really good at 75%, not yet at 80%, but it's rallying even with today's action. It's that weekly chart that says to me that the weight of evidence suggests that there are going to be lower highs and lower lows, and that the really big caps in the Nasdaq are still suffering from being overextended and just need more time, Netflix, et cetera, et cetera. Even actually, I shouldn't say that just off the top of my head. I should be looking at Netflix right now. Yeah, Netflix, Google. I'm going to Google. I can't stand the word alphabet. Google. Yeah, these guys are they're under pressure. Priceline. Acting quite well, but we'll see what happens. Priceline's one of the better ones, and Facebook. Interesting. Facebook has had a nice rally. It's at peak C right now, if there's no new high today, new recovery high. But it's that candle that went to peak G at 117.59 that suggests to me that it is within a boundary between 110 on the upside and probably about 100 to 98 on the downside. If it breaks either of those levels, it'll go higher. If it goes to 111, 112, it'll retest the 115 to 117 all-time high. And if it breaks down under 98, I think that's it for at least another month or two as it consolidates. Facebook trading right now down $1.37. Let's get back to our story. IWM, funnily enough, yesterday had a far better session than many of the others. Now it's pulling back. It's in leg B. The MACD is very good. I've got one indicator here that suggests that it was a little overbought, needs to pull back. And that's exactly what's happening. The stochastic is still rallying, and a peak D in the 120-minute chart. A lot of my charts, we're going to C1, C2, or a peak D in the 120-minute chart. That's why when I saw this signal, the Chapman Wave signal that said, heads up, could be a pullback in the Dow, there should be a pullback to minus early in the morning, regardless of whether the futures are up or not. That's exactly what we got. And now this is, as I say, this is a little deeper in the corrective session I expected. Not if you're looking, look at this. You've gone from 93.64 to about 102 in the IWM. Big deal. You're down less than the 2 points today. You're down at 1.30 from that high. That's nothing. Hey, wait a minute. The weekly chart, though, suggests the flat stochastic and the MACD flat, that the 102.51 9-period exponential moving average and the IWM, the Russell 2000 ETF, is going to be really important. Okay, so you see, as I put the picture together, the suggestion I had yesterday, in terms of looking at, how can I put it? Looking at the levels. Okay, it's easy. I'm looking at this and I'm saying this is I've got to treat it as a counter trend rally. There are certain factors when I look at it, the overall market, if I do a nice big picture, that says that the rotational correction should continue. The rotational recession, is a word, something is an expression I made up. But I absolutely look at so many factors. Look at CTAS. This is Cintas, overalls, clothing, rentals. Don't tell me that since October of last year, was that October? There hasn't been some kind of a recession from 94.38 to 80. That's 14 points, about 12, 13% pullback. That was from October of last year. So I believe that there's something going on here that's very different to what we've seen historically. Okay, now let me just get back here to what I'm looking at. I wanted to go to gold, to go to our callers in 1 second. So gold is acting really well. What I had suggested was that there was a rectangle forming. There's a potential for an H pattern. But if, in fact, we started to rally and the dollar didn't move much high into the 98s, then you could start to see gold make an inside buy signal that goes in the 120-minute, it's already in leg C, to a leg D that might even occur in the daily with slightly higher highs, trying to tackle the high that was made at 1263.90. I'll get into that a little bit more as we move on. I just wanted to show you the chart of the dollar because we have callers, so I'd love to get to our callers. 97.32. The question was I bullish on the dollar? No, what I've been saying is that I don't like the 100.39 high made back in last year in March, and then this year and then again in December at peak C at 100.51. I never like to see a peak B go to a peak C just fractionally and then pull back. So I suspect that the dollar is going to consolidate a little longer before it becomes bullish again, and that's going to continue to help gold. And I think that's kind of what I wanted to cover right now, other than just to say the TLT is acting nicely within a range. It's no big deal, just stuck within a range. Let's go to Ben in Tallahassee. Ben, how are you?
Good, Basil. How are you doing?
I'm well, thank you.
Good. I just found an interesting chart. I'm not sure if you've been talking about this over the last couple of weeks, but the XLE.
Yes.
On a monthly, 3-year monthly I'm looking at, it looks like it's hitting two really key indicators. It's floating just above the 200 EMA, and I think it just made trough D. Okay,
that's a really good point. Now what I'd like to do is this. XLE, folks, is the S&P Select Energy SPIDY ETF. So old SPIDY has had a real tough time since it made that 101.52 high in the middle of 2014. If I take the left side low, now I do this in a special way. I'm going all the way back. I'm going to this low right here. I need to find a candle, a specific candle. That's the candle that I want right there. Now, if I do this, let me just correct that. It needs to go one more bar right there. If I do this is the left side, and I'm going from inside, I'm tucked it into the August 2009 candle, and I've got a base now that says 48.56 is the level of support we've got to monitor. And I'm going to move this down one fraction so that it shows it clearly. That's going to be green. And the next matching right side parallel comes in right here. Before I even do that, I'm going to make it pink and dash. Now, let's see where it fits in. So that's the exact point, and it's going to, bam. Okay, and that goes to June for a retest of the 48.56 low that was made in July of 2010, even though I didn't do the match to that particular point. And now what that's done is it's given me a sense of time. And it said we were within fractions just last month of that low. It went to 49.93, about a point away. That's number one. And number two is the 200-period moving average. Now, I don't know if yours is the same as mine. Mine is showing that the price we're looking at here is around about 58.10. That orange, that kind of, what is it? More like a coral color. Now, what I'm looking at...
Yeah, yep, that's about right, yep.
That's what you get? Okay. So now that gives us a really good benchmark of the magnet that becomes support, resistance, and that you should fluctuate around. So it says, now we can do an analysis to say how far could we rally? If we rally, what will break the magnet of that particular... Can you hold on?
Yes.
Okay. We've got Ben. We'll be back looking at the...
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Dow's down 172. S&P's down 21. And the NASDAQ's down 57. And we've got Ben online. So, Ben, I just did a quick review of the components of the XLE. It's got Exxon. Let me show you the charts as we move on. So it's got Exxon right now making, and in the Chapman wave, what do we look for? The most identifiable low bar. Then you want to merely count each successively higher peak. You want to get to a peak D or E. That's where you got to be real careful. And if you start to see the technicals deteriorate at that point, you've got to say, okay, now we're ready for some kind of a pullback. Well, the stochastic's at 91%. The MACD is still strong on the daily chart. The weekly is improving, but it's only in a brand new A to the upside. But the daily has made a peak E. That's Exxon. If I go to CVX, which is Chevron, CVX is just making a peak D as we speak. MACD is still good. Stochastic's at 77%. That's a little bit low, so you've got to be careful. But wait a minute. If I go to Schlumberger, which is now in leg E under the 200-period moving average, I'm saying, okay, MACD is good. Stochastic's really nice at 89%. So I'm going to suggest going through, I actually had gone through some others yesterday because I was looking at it because I had some other questions. Oxy is the same thing, A, B, C, D. This is an E, sharp candle down. I'm going to suggest that you hold off on the XLE about another day. Why? Because if the technicals are this good, and if the 200-period exponential moving average, which is now coming to focus for most of them, for Exxon, its support, for Occidental, its resistance, if it becomes important, you're going to find that a leading stock like ExxonMobil, at 81.56, down 83 cents, no big deal, down 1%, but it will be a big deal being peak E if Exxon breaks under 79.50. That's not very far away. It's only 2 points. In this market, you'd say 2 points is no big deal for an $81.50 stock. But if it goes 82 points to the upside by Friday, then I'm looking at something completely different. So I'm going to suggest to you that the Exxon, do you have any position now, or are you just waiting patiently?
Yeah, I thought maybe a little bit of energy, given that it's, do you agree the XLE is trough D and is that accurate in the month?
Yeah, oh, absolutely. I didn't finish that. I didn't finish that. Absolutely, you're correct.
So
I meant to say
sure
to you, yes.
You were thinking it looks more like it could trickle down to an E and an F in a monthly or.
Well, that's the thing. You see, the stochastic is flat. It's at 19%, and it hasn't read every time that there's been some energy for a month or two or three to the upside. The stochastic has just remained flat, and the MACD didn't even notice that there was a rally. That MACD's green line, the 9-period differential. So that's the reason why I'm saying I'm going to hold off. I think there are other sectors now that might be a little bit better, and I'm still saying that the commodity index, I looked at it last night. Let me just do it again. There might be a little change right now. So that's going to be TR.
I'm sorry, Basil. I don't want to take up a lot of your time because I know you were going to talk about maybe some long-term trends in the weekly and the monthly and the overall market. I thought what might be beneficial is how you assess like a monthly where it could go to an E and an F versus
to the downside, trough E, trough F. Yes.
Yeah, because that's obviously a huge difference compared to maybe start nibbling at a D.
Right. And the thing about the D is that's where you get your opportunity. But when the commodity index, the Thomson Reuters commodity index, went to the D with a candle that said, hey, this could be very nice. The next candle was kind of not good. It was an inside bar. And then the following candle broke out to the upside, but it couldn't get enough traction. And then the next month, that was the month of November, it went to a lower low. So I really am convinced that we are still in a phase that says, be careful, there's a commoditization of commodities, and I'm including in that just a whole bunch of things, and I'm including in that interest rates. So that's the reason I'm saying to you, I would hold off, and I would only I would not be putting on something that has the potential to be a long-term position just yet. In my mind, I'd only be thinking short-term trade. And one of the big things about this week, and the reason why I'm saying it's so important with XLE, I've got peak C1, peak C2 on the upside, just a nominal, there's a 58.50 high, and then a 58, it went to a D. Sorry, I didn't see that. It's at a D, so you've got almost all of them at a D or an E, and I'm just suggesting it's worth holding off just a moment before you do anything. And I'll tell you why. The weekly chart has too much of a pattern that says the lowercase h can go to a lowercase m, as opposed to what I'm expecting in the Dow, that it's going to squeak somehow or other just high enough to eliminate that idea of two arch formations so that it can make a more of a cup and last a little bit longer to the upside. Very critical couple of days we got here. So I don't think it's worth really, I wouldn't even do anything other than think about starting a position if it holds 56 to 55, and I'd do a little nibbling, but I'd have to wait to see how the technicals hold over the next 2 days.
Very good. Thanks a lot, Basil.
Pleasure, and always you bring up very good subjects. Thank you, Ben. Thanks for calling. So, folks, let's get back to this. Now, I want you to talk. I'll take a moment here. I will get to this longer term. Here's my thinking. How long has the Dow corrected? Well, it's corrected since, well, where did I type that? I typed it over there. It's corrected since May of last year. So wait a minute, you're in a major bull market, and then you get a correction, and all that can happen is that the market drops. What did we say it was? I can't even remember now. Was it 13, 15%? I'll do that in a moment. I'll do it in a moment. Let me just type it in here. The Dow drops from 18,351 to the low of August of 15,370. That's 3,000 points. So what are we talking about there? I should know this right away. Now we're talking about 16%. No, I'm going to do it. Give me a second. I had it all written up and typed, and I remembered it, but I am now in a moment of a moment here. I want you to see what it is exactly. I'll tell you why. Someone's going to tell me. So we went to 18,351, and then we went to 15,370, and what is the percentage? Yeah, 16%. Huh, I thought I had that down. So 16% in 9 months. No more. 10 months. 9 months. That really is very impressive in time, because once the trend changes, especially after a major bull market move, you would expect that there'd be something way more serious than that. You would expect at least 22%, which was what we saw back in 2011, when the Dow went from 12,876 down to about 10,400. Yeah, this is, so far you've got to be impressed that with all the bad news that's coming out, the market has held this well. Now, I want to talk, I'm going to just deviate for 1 second, and I'm going to say, back in 1982, it turned out, I did not know it at the time, but the day that my daughter was born, I got a major buy signal in July of 1982. I was using on-balance volume. I was using a bunch of technical stuff, all hand done. There was nothing computerized. I used to spend hours before I went off to be a musician full-time. Came back to my stock market report. And it was only about in August that we got that breakout, the Reagan.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
I was just showing you the 10-minute chart here based on the Chapman wave. We've done about almost a 1-to-1 to the downside from that peak D in the 10-minute chart. You've got a whole bunch of things that suggest that that 1918 area should hold as support. If it doesn't, this is way more serious, but if it holds as support, I would suggest to you that by 12:30 you should be testing this low that was made at 12:40 on the 22nd, 22:40. So last night at 19:26.50, and if that gets taken out, then the target would be by 2:10 this afternoon, the 1929 level. So it's going to be a very important phase. Okay, let's get back to our story. So we've just jumped from 10 minutes to the monthly, very long-term chart. What I wanted to show you here, boy, if I can just find out, I'll use the S&P, doesn't matter. So you can see that the S&P in this monthly chart, looking at the channels, we've broken this channel. Whenever we've broken the channel before, that's especially after a peak, in this case a G, but a peak of significance, in this case May of 2015 at 2134, having come down from 2134 to 1810, that's 320 points. Now that's a little different. Wait a minute, let's just see what that is. So then what have we got there? We got 2134, and what did I say? It was 1810. 1810. No, 15%. Yeah, so that's a little bit better. I'm looking at this and I'm suggesting to you that there is a difference. That I looked at these charts very closely over the weekend. There is a difference in the time because, look, you made a high back in October of 2007, and it was in March of 2008 that it went down to that 1256 low that was a bounce, and then it broke down. In this particular instance, we've gone all the way from May to the month of February. So there's a difference in the time that we've taken. And I'm also looking at it and I'm saying, I'm looking at so much negativity, but I'm also looking at some charts that are really important so that if we have a rotational correction, and a correction can be upside and downside. Remember, corrections can be that you've gone down enough that now you're correcting that decline by moving higher. And there are enough stocks, like in Alcoa, like certain stocks that are, or certain stocks even in the high tech, like we've got one that was just the left out stock completely. Now it's suddenly become a little bit lovable. And if you can keep finding these things, I think that it's saying that there's a chance that the monthly chart takes time, which means that we could still have another arch formation, but we don't have to smash to the downside. We could take a year to consolidate, a little less than a year, maybe into March or so. So here's my thinking. I want to make this as clear as I can make it. I would not get carried away. Remember, over the period of a year now, I've been saying, time to take some money off, a little money off, but keep your core position, especially if you're holding funds or whatever it is, just good core positions. Now I'm saying, I'm beginning to see enough evidence to suggest that we've used up time, and I cannot deny that there's ugliness in monthly charts. Look at this. I'll run through a couple of them right now. Here's the Dow. The MACD looks terrible. The stochastic looks not great, not as bad as it was when you made that low in August, but not great. Okay, and the MACD is worse, the stochastic, okay. But what's really important about it is look at the base of support that you've got here. Now, very often the number of times you hit the base is very important because it's saying that base better become a trampoline support or a cushion at worst, but a trampoline at best, because otherwise price will go right through it. You can only hit it so many times if the technicals are weakening. So here's what I'm looking at. February has got another five sessions or so to go till Monday. In this market, that's no time at all. You can smash to all you need to do is go into this candle. I'm making it real simple. If the Dow closes on a monthly basis, I'd say even on a weekly, but I really want to be cautious and say on a monthly basis, under 16,000, be careful. That says we're going to go down even lower. Now, here's the part that I want to put in here, because it's counter-trend thinking. It's counter-thinking if you think of how many people, just the regular old bulls are always the bulls, but there are a lot of bulls that became bears recently, and there are a lot of bears that are talking about smash, that's it. The way I'm looking at this, if I look at automobiles, I don't want to get into that. I'm not going to take the time right now. I want to do, but I won't. I won't talk about Trump. People talk about the relationship of Reagan and Trump. Yes, there is some kind of a relationship personality-wise. If you read Reagan's letters to personal people, just to people that wrote to him and he wrote back, it is without any mistakes. I've never written a letter in my life without having to cross something. That's why I love the computer. He never made mistakes. He just was clear in his thinking. He wrote passionate letters. So there's a very big difference. Doesn't mean to say that there'll be a difference in outcome. We'll talk about that. So I'm going to set that aside because it's really important, but I want to take time to think about it. So here's what I'm really looking at. I'm going to go to you see those Roman candles? You had two parallel Roman candles. His bases were just about parallel. But wait a minute. Look at the S&P SPX.X. This is normal. This is what you see. This is what you saw in 2007. Look, 2007, Chapman wave Roman candle. Chapman wave Roman candle. Rallies. Bam, bam. Chapman wave Roman candle. Bam, 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 bam. All the way down. I think that at this particular point, I have to say the jury's out. But there is a way to do this. And I'm thinking that if you were to at least start a position, if you haven't got anything, if you're mostly in cash, there's a chance that this market actually could go a little longer and to the upside, that you could garner enough 3 to 7%. If everything works the way it might work if certain conditions are met. A lot depends on the VIX index. So I was suggesting yesterday that a small long position, just to be there, to be able to get a feel for what you can cope with, what you're expecting. And especially if you're in cash, I mean, what's the big deal? So you lose, I put a stop in of 2 or 3%. I think a 2-3% when you've got the potential to make that on the upside, and that's not the issue. The issue is that if the S&P gets into the body of this candle, of this Roman candle, gets into the 1969 to 1986 level, it's a big F, but if it does that, you've changed the complexion completely of this chart formation. That's my thinking. And all I'm saying is that you can make it real simple. The S&P goes to 1890, under 80, closes under 1890. You're done. That's it. You don't want to be doing anything. So how would I do this? Here's my recommendation. That if you are if you've been building up a cash position because you've just not liked this market, I'm going to suggest, we've got a little break coming up here. Let me think through the way I want to articulate it, because I don't want to say if this, if that, if this. I want to give you exact numbers that I'd be looking at, and I'm going to give you my reasoning as to why. So I'll be back. Basil Chapman, Target Technicians Hour. Dow's improved a little bit, down 149. S&P's down 17.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with Swim Lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
Hi, folks, we're back. Sorry, I got a whole bunch of emails right here. I'll try to do them tomorrow, but in the meantime, two questions that I do want to cover, and I'm going to finish up on this just real quickly, because I think this is actually now very important. The GLD has had a spectacular move to the upside, going from the 100 level, just over 100, to almost 120. It's called it 100 to 120. At 20%, that's huge. So it deserves kind of a rest period. But the dollar itself is holding well, but not doing great. And I'm suggesting that the dollar might have limit, unless the dollar can really break above 98.50 in the next few days. I think that gold is holding up well for a reason. And I have to really think very closely. I have to go through a number of factors to say, hey, wait a minute, is gold holding up well? XLF is not doing too great, it's not doing too badly, but it's really not doing too great. Is something waiting out there that is just terrible? That's why gold is holding well. So here we go. I'm going to suggest, if you haven't done it already, you could even start a little position in the Dow Diamonds. This has got nothing to do with what you've taken off. This is like a separate thing completely. And what it's saying is, I want to get, and I believe that the Dow is really, for the first time in ages, a very good proxy for the general market. That's number one. Number two, I'm going to suggest that you don't get carried away. It's at 164.35. You can buy 20 shares, 15 shares. I want you to get a feel for yourself for what you think the market is telling you. The arch formation in the weekly charts is can't expect much more than an arch formation, but it could go from 164 up to the 170, 168 and a half to even touch 170 if everything comes right over the next few days. This is a little deeper pullback than I wanted to see, but the day's young. We'll see what happens by the end of the day. So I would wait. I wouldn't do anything today in the Dow Diamonds, but I'd wait either tomorrow or the next day, but somewhere between where it is now at 164.40 to 163.30. And it's a $163 stock. So I'm going to say I would not even give it much room. Why? Because at 161.50-ish, if it takes that out, it says, no, not good action at all. But at the same time, it's going to give you a really good feeling for what's working, and you'll be looking at the Dow, what's in the Dow type stocks, the defensive stocks, the oil stocks, the bank stocks, that is the financial stocks. And it's going to give you a sense of what's working. And all I can say is by Friday, regardless of what's going on today, if by Friday the Dow Diamonds trading at 164.40, that's the trading vehicle for the Dow, if the Dow Diamonds are anywhere close to 166.50 to 167, that's quite a bit to go from where it is right now. But if it does that, it's saying that this counter trend rally is trying to form a higher base. That's really what I'm getting at. And that higher base makes the most recent lows very important. And if those lows, those rising lows, are to be believed as springboards to the upside, we might find that the correction now has gone 2/3 of the way, with maybe not even maybe more than 2/3, and that there might not be much left. Now, the VIX index, just as we wrap up, you're about to go for your swimming lesson with Think or Swim. So here we go. The VIX, as I said to my subscribers, I think the VIX will get over 20 today. But if it holds over 20, that's one thing. So it went all the way to 2107. It's at 2060. For whatever reason, I don't care. If the VIX is able by, tomorrow's a Wednesday, by Thursday at this time, if I'm talking to you and the VIX is a 19.70 or lower, that's really going to help the market. If the VIX has decided, no, the selling pressure is going to be maintained, it'll go to 2150 and touch the 2206 9-period exponential moving average. So let's just review that again. If you're in mostly cash or you're very defensive, I'm suggesting that you can start just a very small, this is something so that independent of me or any of the others, you're going to get a real good feeling for what the market has, and you can just nibble on some of the Dow Diamonds. And the stop would be at 161.50. So that's it for...
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,